Good day to everybody who's dialing in and listening to us today. Today we've got Gabriel Radzaminski from Sandon Capital, which is an emerging company activist fund that we have done work on and are endorsing across the GP Wealth network. We particularly like this fund given where we are placed in the market at the moment. I'll let Gabriel to go through a bit about their activist strategy. And we often find that a lot of emerging company managers or specialist managers, we like to add to complement our skill set as they're able to bring together a speciality that we might lack or they might be extremely proficient in. And we also think that given the dislocation in some of the valuations in the market and Sandon's unique way of approach in that space, there are some pretty compelling opportunities in the next 6 to 12 months and beyond that give a very good validation for us to explore the strategy more. So I'll hand over to Gabriel just to introduce a bit about the fund and also their feedback on reporting season and a couple of opportunities they have a high conviction on. And we'll also be kind of happy to follow up and answer any more questions offline for any people that want to understand more about the fund. With that, Gabriel.
No, thank you. And thanks for the opportunity to come and speak to you all. So what we are, Sandon Capital, we've been around for quite some time. Yesterday was actually the 14th anniversary of our flagship fund, Sandon Capital Activist Fund. So that was started on the 4th of September 2009. So we're sort of well on our way to establishing a long-term track record. Still a way to go. The firm overall manages about $190, $200 million across two different, if you want to tap through. So there's the usual disclaimer. So there's the snapshot of the firm. We've got two structures. We've got our wholesale fund, which, as I said, has been around for 14 years. We've got our listed investment company, which will be 10 years at the end of this year. We follow the same strategy across both products. We are a value investor, so we're bargain hunters. We're looking for cheap things where we can find them. But we also acknowledge that things are usually cheap for a reason. Therefore, what we're trying to do is understand why they're cheap and whether we can do things that change that dynamic. That's where the activism comes in. So we're not just waiting, buying something, crossing our fingers and hoping for mean reversion to take the share price back to where it should be. What we're doing is getting actively involved to try and change either the way the company is doing something. That could involve a change of strategy, could involve rationalizing assets, selling assets. Sometimes it also involves telling them to basically, call time. Your experiment's over and you need to wind up and give all the money back to shareholders. All we're doing is using our rights as shareholders to try and get better outcomes. Broadly speaking, if we turn the page, what we're doing is using active engagement. The target return, the threshold that we apply to all of our investments is that we'd like to see opportunities to earn 15% per annum compound. That means that we're trying to double our investments every 5 years. Given the history of the fund, until sort of October last year, when small and mid-cap stocks really got hit as interest rate increases took hold, we were actually quite close to our long-term target. But our performance has sort of withered a little bit in the last 18 months. It's picked up this calendar year, but last year was quite rough for us. But we do focus on that sort of 5-year doubling. Our top 10 positions is around 50 to 70%, depending. At the moment, it's about 70. We're very concentrated. When we get into something, we get to know it very well, and we're very committed to achieving the changes we're looking for. And the focus is predominantly small and mid-cap companies. Next slide just sort of summarizes the approach we take. It's deep fundamental research. We spend a lot of time working on companies. It came up in a conversation yesterday when someone asked us about when we invested in something. And the moment we invested was really the culmination of several years of just keeping an eye on things. What we're looking to do when we invest is to see a confluence of value, i.e. when price is disconnected from the value of a company. But we're also looking for an opportunity, and that's where the activism comes in. And the two have to sort of come together. And that's the old Venn diagram, value opportunity, where they intersect. That's when we invest. We see ourselves as owners of the businesses we invest in, not just traders of bits of paper. And I think that's something that we think distinguishes us from a lot of small cap managers. And look, there's a lot of good operators out there, but they tend to be data point driven. Portfolio turnover for us is quite low, typically averages around 20-30% per annum. So you compare that to most small cap managers who are probably turning over 100 to 150% or more. We don't trade. That's not our stock in trade. Most of our exits, or a lot of our exits, actually take place by way of corporate transactions. That's how we get out of things. We get in things by just patiently accumulating. If we turn the page, I won't spend too much time on the next two slides, but this one probably encapsulates what we do. We've been doing this for a long time. We've done over 40 campaigns. I think we're up to 41, 42 at the moment. And each one of them is different, but they tend to follow a similar path. We privately engage, we seek to engage privately with the companies. Typically that involves writing to the chair, introducing ourselves and asking some questions and putting forward some suggestions of what we think based on our research. We don't
position before that though.
Yeah, we don't normally meet with companies before establishing a position. We take the view that everything we need to know is in the market. Continuous disclosure obligations require. Plus, given who we are, it's not like they're going to be particularly open and forthcoming with us. So when we approach them, we've already done our homework. It's also a bit of a fact-checking exercise where they've got an opportunity to rebut anything that we might have misunderstood or made mistakes on. Boards respond in one of two ways. Either they engage, doesn't mean they agree, but they might engage, or they just ignore you. We're indifferent because that then dictates what happens next. Our view is that the best activist campaigns are the ones, and the most successful ones are the ones not where you convince the company, but where you convince shareholders, because it's shareholders who ultimately dictate what a company will do. Boards typically undertake strategies that they are committed to, that they believe for whatever reason is the right thing to do. Shareholders don't always agree. We then basically follow the path of making a presentation public. The reason we do that is that for a lot of the institutional investors that we deal with, and they are our main stakeholders, other fund managers are the people that we spend most time talking to. For a lot of them, for example, some of the very large ones, they've got internal compliance programs where if they receive an email that has anything that looks like non-public information, the alarm bells go off. So what we've developed over the years is the approach of making public a presentation so that everything we talk about is in the public domain. So no one can, no one bears the risk of inadvertently dealing on material non-public information. And then we look to either convince the company to do something the easy way, and sometimes we go through to proxy fights. So we've had experience in all of these things. So over the years, we've done hot contests in proxy battles, we've done takeovers panel, we've done all sorts of things. At the end of the day, it's just about a repeatable process. On the next slide, which I won't spend much time on, just basically gives you a sort of step-by-step overview of what we do. Obviously, we're trying to show enough of an insight into how detailed our work is, but we don't want to give everything away either. The irony in Australia is that there are not many people that do activism. So for the bulk of the 14 years that we've been running our fund, we were the only people doing it. In the last year, there's probably been about 3 people join the club, and that's good, more the merrier. But that said, investors' reluctance to do activism belies the fact that Australia's corporate laws are some of the most shareholder-friendly laws anywhere in the world. When we do activism here, it's fought in the court of shareholder opinion, i.e. the majority of shareholders dictate the outcome. In the US, by contrast, it's typically fought in courts of law, where its lawyers is at 50 paces and, hanging on the outcome of a judgment that may or may not deliver the result you want. So we've got a very good, solid environment in which to conduct the activism, but there are very few people who are willing to do it. Some of the people that I mentioned before who have come to activism in recent times, they try and sell themselves as being constructive activists. As far as I'm concerned, that's an oxymoron. The reality is, if a company does not want to do what you're suggesting, what are you going to do? Sit there and, whack them with wet lettuce? No, you've actually got to be prepared to do things. So we are prepared to. So we're happy to engage privately if it works, but we're also prepared to go overtly hostile in public if needs be. And you can see that in a number of our campaigns over the years. The next slide, again, tries to just summarize what we see as the high-level opportunity. And some of these things are, I think, anathema to a lot of investors. If you think to the language that is used by most fund managers that you will hear from, they tend to describe companies with the words consistent, reliable, predictable. Those three words, for example, are the exact antithesis of the word change. Most investors don't like change. We're typically out there selling change. The best time to sell change is when people are fearful, when they've lost money, or they fear that they might lose more. And so what that means is, and that's where the value play comes in, we're typically buying into companies that have already bombed out, that have already caused grief to their investors, because that's when investors are more likely to change their minds and back a different horse or a different course. Volatility is always good for us. Again, it creates fear, it creates uncertainty. And if we can offer a tangible solution to that fear and anxiety and uncertainty, we're more likely to see other investors support the changes that we promote or propose in a company. Just generally, and look, this is from earlier in the year, but I think it still applies. We see that the volatility that's occurring in markets now, combined with, and just as we walked over here, the Reserve Bank announced that interest rates were staying flat. I think that some relative stability in economic conditions will be an impetus for companies to pull the trigger on more M&A. Interest rates, to a point, the absolute level of interest rates don't necessarily matter that much as to people thinking that they're stable, that they're sort of that this is the new normal. Now, I don't know if it is, but if people feel that interest rates are around where they're going to be for the next little while, certainly on the way up, if they're not going to go up any further, that means a lot of companies are going to become more emboldened, which means they might do things. Now, company that I'm going to talk about later is one of those ones where we want them to be unemboldened. We don't want them to do things that they might want to do in M&A, but that also means that for some of the companies that we're invested in, it could be that we see exits for them. Now, again, the last point on this is interesting because I think in recent times, there is less interest in ESG. It might be, looking back in a couple of years, we might find that ESG was very much a fair weather friend that was predominant when markets were benign and everything was good and money was cheap. I don't know. Time will tell, but we do think that there are some important issues, both on the environmental, the social, and particularly the governance aspects of companies that make investor attention very important. And you're seeing that playing out in, for example, Qantas in recent days. The next slide gives you a bit of an overall perspective in the market. Now, we've taken this from Goldman's strategy team, and basically what we're just showing here, or what they're showing, which we think is worth considering, is the disparity in the market between large and small growth and value. They put out a report on Sunday night, which was their recap of reporting season. And what they found was that 37% of companies in the ASX 200 beat expectations or beat guidance. 38 underperformed, and the rest were neutral. But of the ones that beat, most of them actually went down afterwards. So the market, I think, is quite subdued. They also make the comment in their Sunday note that earnings, the results season this year was far better than analysts and fund managers had expected, because most people had much more sort of dour outlooks on the economy. And again, I think the observation that we would make, and again, this doesn't dictate our investment approach necessarily, but it's really hard for people to disassociate their personal experience from work. If you've got a mortgage, you're suffering. Costs have gone up. There was a study the other day, I think ANU put out, that the average mortgage holder over the last 12 months has had a 17% increase in their cost of living. Renters on average have had a 10% increase. So despite the fact that rental increases are a big issue, reality is mortgage holders have paid the brunt of it. Someone was telling us at another financial services firm somewhere over there that they'd noticed that more and more of their colleagues were bringing lunch into work. Restaurant bookings are down. 3 months ago, a number of restaurants were very difficult to get bookings at the last minute. This week, you can get most tables. You can get a place if you want. Airline airfares have come off. If you look at Sydney, Melbourne with Qantas and Virgin, you can basically get ready specials or whatever the Virgin equivalent is now for a week out at around $155. 2 months ago, they were about $240, $300. So I think a lot of people's perceptions have been clouded by their own experience, but things are definitely, the heat is coming out of things. But from our perspective, there's multiple speeds in the economy. There is the people who are doing it tough, and that's really hard. There's other parts of the economy that are absolutely booming. So things that are exposed to infrastructure, resources, and to a lesser degree, agriculture are doing very, very well. Our biggest holdings by weight in the portfolio and by weight across the portfolio are those three sectors. We describe it as the industrial economy, for lack of a better word. Largest holding is Fleetwood. They do.
So just on that, there's a big spread as well between large and small caps.
Yes, sorry. Yeah. So again, sorry, just on that chart, the disparity between large cap and small cap. So again, in times of turmoil, people tend to move away from small and go to the safety of large caps or get out altogether. Various brokers and advisors that we speak with tell us that there are huge amounts of cash sitting on the sidelines. People are waiting, but they don't necessarily yet have the conviction to do something with it. From our perspective, we simply look at our performance this calendar year from December to now. We're up over 10%. It's nearly double the market. We've been fully invested since then. Well, we've been fully invested the whole way. We don't tend to time the market. Excuse me. But that industrial economy is very, very strong. So we just had lunch with the MD and the CFO of Fleetwood, our largest holding. They've got a Searipple accommodation village in Karratha, Western Australia. It's lost, I think, on a lot of people sitting here in Sydney or in Melbourne. Karratha is literally in the midst of a phenomenally large construction boom where there are massive infrastructure projects, or infrastructure is not the right word. There are massive resources and energy projects being built in and around Karratha that are likely to exceed the peak of the last super cycle. So 12 months ago, speaking to people who operate in Karratha, they were saying, oh, it's going to be good, but nowhere near what it was back in sort of 2010, 2012. Now people are saying, oh, it actually could be as big as it was back then. You've got things like Perdaman urea plant, $4.5 billion. Now, the reality is when the final bill comes in, they're probably going to have a cost blowout to, probably another 20, 30% because there is still labour costs increasing. You've got Woodside with Browse, Pluto, and all their offshore projects. BP are doing massive solar projects. The Karratha area is likely to become the global hydrogen epicenter in terms of clean energy. Rio Tinto is building a $1 billion desalination plant. Then you've got all the other mining projects in and around that area that were built 20 years ago that are now coming up to upgrade time. So the pipeline of work is huge. According to the Karratha local council, which we think that they're a bit, they're exaggerating and taking some poetic license, but on their website, they claim there's $40 billion worth of projects in and around the Karratha area that are slated now. And even Fleetwood agree, the number is actually much lower, but it's still tens of billions of dollars. So we see that as being a medium-term opportunity, both for Fleetwood. Coventry, which is another of our large holdings, they just recently told us when they were in that they're opening a branch in Karratha. Because suddenly Karratha has got population density of 70,000. Their benchmark for opening a new branch is a 40,000 population catchment area. But they're looking to supply fasteners to all of those big projects. I mean, if you imagine a urea plant, to be honest with you, I don't actually know what a urea plant looks like, but it's got lots of pipes, lots of things, but they all need to be screwed together with fasteners. That's what Coventry supplies. Cog Financial, which is our second largest holding in the fund, they're the owner of the largest SME finance broker network in the country. Now, finance brokers, the best way of thinking of what COG is doing, they are applying the steadfast Austbrokers model from insurance to finance brokers. So they're out there buying brokers all around the country, and they basically deliver SME finance, so leases, chattel mortgages to small and medium-sized businesses. Best way of describing that, it's the tradie economy. So again, infrastructure. They've recently bought a novated or added a business to their novated leasing business. Electric vehicles are running out the door. They cannot keep up with the supply. And the same is true for other novated leasing companies, Macmillan, Shakespeare, and so on and so forth. But COG is in that. They brokered last year $7.7 billion worth of net asset finance. Just post 30 June, they acquired another aggregator that brought on another $1 billion. We're expecting that FY24, they're probably going to come in at nearly over $9 billion of net asset finance, if not close to 10. The brokers are the ones who manage the relationships. There's a lot of interest, for example, in Judo Bank. Judo Bank relies on brokers like COG to feed them their deals. Now they'll tell us, Judo Bank do a great job. They're telling a good story about the fact that they've got their business specialists, but they ultimately rely on brokers. Brokers are the intermediaries that make that whole place work. COG's also built out a credit funds management business where they've got now nearly $500 million funds under management in credit products that help them blend out the funding sources for their brokers to sell to their clients. If we turn the slide, the other one, sorry, before I do get on to Magellan, the other one that is a key holding for us is global data centers. So we went substantial in them earlier this year, and then someone else went substantial as well. And between between the two of us and management, there was a recut of the management arrangement with a view to incentivizing a realization strategy rather than an asset maintenance strategy. So we're expecting some pretty good things out of GDC. The briefings that Dave Ewell was giving most recently would suggest that he's very confident of realizations north of $3 on a gross basis. Now, obviously, he needs to take his cut of performance fees, but I think that compares quite favourably to the share price, which is, I think, around $1.60, or give or take. Okay, so Magellan. Magellan is our most recent public campaign. I don't think there's anyone in the market who doesn't know about Magellan or who doesn't have an opinion about it. Most opinions are negative. We saw it a little bit differently. We've been following it like most people. Well, in the newspaper, we've been following it. Joe Aston's made a very entertaining story with Magellan. There were some times where in the depths of winter, you were keen to get up and out of bed to get the paper just to read what he'd written. But that said, what has been left behind is it's still an immensely valuable business. We started buying in March of this year. We decided that it had reached a point where all the problems were more than adequately covered by the price that we could buy Magellan shares for. We then began an engagement campaign, and that's where we're in at the moment. If you turn the slide to the next page, this just gives you a snapshot of where we are. On the right-hand side is an extract from our 27 June presentation, which detailed our investment thesis. What attracted to us what attracted to us to Magellan at that time was that for roughly $8.15 per share, we were paying about $350 million for the funds management business. That was the price implied. And the reason we come to that number is that if we took out the cash of $350 million, there were investments in their own funds of just over $400 million. There were investments in associates like FinClear and Barrenjoey, which together represented around $6.20 per share of value. The balance of that was the value that was imputed to the funds management business. We saw that particularly the cash and the investments in the funds as being something that underpinned the downside for our investment. We argued that the company needed to do 5 simple things, and that was to return excess capital to shareholders. That's really the first 2, the cash and the investments, and that could have been that could have been and should now be either by way of special dividends, buybacks on market, or even in specie distribution of interest in the various funds they have.
So they've announced a special dividend of 30
A small token special dividend. So that's why on the left-hand side, the little table, I've put the 5 recommendations and the results so far as we assess it. So returning capital, that's a work in progress. Prioritising the existing business, that's a work in progress too. The problem we have with Magellan today is that the new CEO, who's been there for over a year now, has a stated ambition of returning the business to $100 billion. And we think that is frankly delusional. It's not just because we decided to say nay to his yay. It's actually born of an understanding of how Magellan got to where it got to. So if you think about what Magellan did, and full credit goes to Hamish Douglas and Chris Mackay, they set out with an incredible opportunity, which was they identified that the Australian market was short global equities. In most retail financial planners and most retail investor portfolios, global equities were underweight. They also correctly identified that there was really no brand name manager in that space. I mean, there was Platinum, but no one understands what Platinum invests in. What they did was decided that the opportunity was to deliver products that invested in companies that people knew. Amazon, Microsoft, Netflix. At the end of the day, it's a pretty basic strategy, but that said, it still worked. What they also did was hired a chap called Frank Casarotti, who arguably had the best golden Rolodex in financial planning land. So they ticked off the distribution side of things. They hired Gerald Stack, who was running arguably one of the best infrastructure equities businesses and still is today. And so it was a confluence of product, opportunity, people. And Hamish came out of the blocks with a -7% return when the MSCI did -27. So suddenly they were able to say, hey, we can also invest and protect your downside. So we would argue that those factors all came together at once and created the Lollapalooza effect for Magellan, which propelled them to $118 billion at their peak. But just because they got to 100 billion doesn't mean they can get back there. We don't think that any of those factors are repeatable. They were unique, and they all came about in an incredibly unique, unrepeatable way. But what they have today with nearly $40 billion still is an immensely valuable business. So we've argued to them, both privately and now publicly, that they should do everything to prioritise their existing business. The old adage, bird in the hand, two in the bush. They have a very plump, tasty bird in their hand. That's $40 billion or $38 billion of funds under management. They need to do everything they can to prioritise the preservation of that money. They need to regain the confidence of their clients. And when I say clients, they're the investors in their funds. And if they can regain that trust, that confidence, they can restore value. Instead, we have a CEO who is unproven in management. He's come from the Future Fund as an asset consultant, has never run a P&L. Now combined with a new chair who has a reputation for making acquisitions. And we see those two as very dangerous ingredients that jeopardize value. So we're now in phase 2 of our campaign, which is to work towards the AGM. Now, we don't know what will be in the notice of meeting. That will come out probably by the end of this month. Once we know what figures in the notice of meeting, we'll be able to refine exactly what our campaign will be from now to the AGM. But at a pinch, we'd certainly expect that we'll be looking to try and have a strike on the REM report. The CEO is paid off the scale relative to his peer group. The company don't have any LTIs. And they've paid huge short-term cash bonuses to a couple of executives. So we think there's a really good campaign to be run just on REM, let alone the strategy. So I mentioned before that fund managers and other shareholders are our key stakeholders. And if you go back to the slide before, you don't have to, but the chart is, we've spent most of the last couple of months since we went public speaking to shareholders of Magellan, people who are interested in Magellan shares, even some who are short Magellan shares. But we've been out spreading the word, trying to talk to people and engage with shareholders about our views. And for the most part, I think we get a sympathetic response. we've got to try and make that sympathetic response translate into votes at the AGM. Because at the end of the day, the board have basically rebuked the idea that they should abandon M&A, that they've rebuked the idea that they should give up on $100 billion of fund ambition. So we've got to take it back up a notch to, you know, the way we typically engage with the board is, look, there's two ways we can achieve what we need, the easy way or the hard way. You'll determine whether it's which way we go. So I think these guys have chosen the hard way.
So in your views, I mean, if we were to sit here in 12 months and we've seen a decent appreciation in Magellan's share price, what needs to happen?
I think they need to.
Basically scrap the $100 billion plan.
Scrap $100 billion and give some money back.
And if they're not going to, and they're going to rebuke that, and they're going to try and grow it, what sort of downside risk do you see on that? And how do you model that 38 billion of funds under management?
We've got that. So again, it's not to forecast, because at the end of the day, we can't forecast it, but we've modeled various scenarios, and we do expect FUM to continue to decline for the next couple of years. But if you think that the company needs to simply return to meeting expectations, and I say meeting, not beating. If you assume long run returns on the various asset classes, that alone, less the roughly 4% that they distribute to their unit holders each year, that alone can create 5 to 6% compound per annum growth over the next, sort of 10 years, including a decline for the next few years. But if they can actually, and we met with someone today, an asset consultant, someone who advises on a large number of financial planning groups and accounting groups.
And has exposure to Magellan in headstock, and
we don't want to go into too much detail, sorry. But they made the point that, Magellan is a bit too expensive at the moment. But my key takeout from what they were saying was that it doesn't actually take much for them to change their mind. And that's what we want them to do. We want the advisors, we want the people who advise the advisors, and we want the retail investors to just change their mind, but that takes time. A good thing is already we're not reading about, illustrious leaders in the paper wearing black turtlenecks and, gallivanting around Europe on yachts. That's a good thing. Joe Aston hasn't written about it for a while. That's a good thing. The ideal is that these guys just knuckle down and deliver
get back to their
index performance. If they beat the index and there's a performance fee, that's great, but we don't need that. And so, again, there's a lot of focus on month-on-month FUM, and our view is that in doing that, people are missing the wood for the trees. The value of this business is enormous. So there's one of the global bulge bracket brokers put out a research note valuing Magellan shares at $8. It's a sell. Then you look at the research and you read it and you realize, holy shit. If the guy's got a CFA, he should be handing it back, because what he's done is valued the funds management business at $8, and he's forgotten to add back all the
1.2 billion or whatever sitting on balance sheet.
So, and funnily enough, that $8 is roughly what we value the funds management business at. It's just that we also remembered to add back the cash and the non-core assets and Barrenjoey and Finkley.
So he'll be doing that, you'd expect then someone.
Oh, I don't know.
No?
I don't care. That's why we pay attention to broker research. Sorry.
So again, around $12, that would mean 12.
No, look, we don't discuss what our value is, but we rather explain how it compares relative to everyone else. And Magellan is literally down here, and everyone else is up here.
And how's that coincide with Chris Mackay selling 6.6% recently? And then also the talk that it was Phil King covering a short.
Again, we don't know for a fact. Well, we know for a fact that Chris sold. We know for a fact that short interest declined significantly, which leads you to sort of, my powers of induction would suggest that you put you put +6 - 2, and you get to 4, and it gets split up. So yeah, I think that's what happened, that someone covered a short. I don't know if it was all Regal, but certainly a large chunk of Chris's stake, I think, went to short covering. So, there are people who've suggested that Chris selling is not is a vote of no confidence in the company. Apparently, he says it's not. But at the end of the day, he sold at a price that we certainly would be selling it.
And what about Magellan getting taken over by another funds management company?
So this is the one where it's a case of do as I say, not as I do. So we don't want to see Magellan take over anyone else because we know that they typically company in funds management or in most M&A, people overpay for things. That's as a buyer, we don't want to overpay. As a seller, we're happy to give it away to someone if someone wants to come in. But again, and this is part of the reason we want capital returned. M&A is typically priced as a function of share price. So the standard is at the moment, you're probably paying 30-40% premium to market price. Now that sounds great. But the thing is, if the market price is deeply undervaluing the company, your premium might only just take you to fair value without a premium. So what we're saying, and if you could go to the next slide. So if you look down the bottom there, the implied value of the funds management business, with the stock at around $9.50, the implied value of the funds management business is nearly $3. Now, $3 increase, $3 versus $2 is a 50% increase. But $9 on $8 is a much smaller percentage increase. So what we're saying is if they reduce the denominator by giving capital back, any premium that comes along is going to be much more impactful. Plus, by taking cash off the table, it basically, a company with cash has money to spend. Jimmy Goldsmith was reputed to have said most companies manage themselves and their cash with a full bladder syndrome, which is when it's full, you piss it up against the wall. Sorry, excuse my language. I forgot it was being recorded. That's why companies that have a lot of money and have ambitions and aspirations to make acquisition for us are a recipe for disaster because they can actually do it. Yeah. Whereas if I said, we manage $200 million and it's pretty much fully invested. And if I then said to you, I've got ambitions of taking over CommBank, you can sort of smirk and laugh at me for being delusional, but you know that there is absolutely no risk that I can ever actually implement that plan. Problem is when you've got the cash, you can. And you look at what's happening in funds management land today, you've got Pacific Current being, stalked by Regal and possibly GQG. We spent some time speaking to analysts in the UK who covered Jupiter, which is the last place that Andrew Formica worked before he left and subsequently came back to Australia. And the guy there was saying that, funds management acquisitions in the UK tends to be a company with problems looks to M&A to solve the problem. And it typically buys a company that's got its own problems. So you've got two businesses with problems smacked together and it's more than double the problem. There was another one today, which I read in one of the newsletters I see, and the guy was describing wealth management, funds management acquisitions. And he said, they're like Richard Burton and Elizabeth Taylor, volatile and unpredictable, or for those under 40, Angelina Jolie and Billy Bob Thornton, just weird. So, to us as a buyer, we don't want to see M&A, but we're more than happy to consider being sold if the price is right.